With peace talks all around, should you sell your Woodside and Santos share? Is Paul Rickard sorry he bought Zip last week? And the Fed, what will they do with interest rates? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Well, Paul, I feel a bit like a genius with Woodside. I bought in at 18, it's now 30 odd. We're thinking about selling today and taking the profit. We might be sorry if war breaks out again worse, but what do you think?
Look, I think it's in profit zone, Peter. I mean, I'm a long-standing Woodside shareholder that's seen it, has bought us high in the 40s, right? That was a couple of decades ago, and bought it in the $18 not so long ago. When it gets to $30, I reckon it's sort of profit area, Pete, because look, Woodside, it's doing some good things, but it's always been a bit of a gunner company. We're going to get the demerger later in the year, which should be good, but we're going to see a lot more Woodside shares on the marketplace come the end of June. I think you get a chance to buy below 30 again, and I think oil prices, you know, they got out of hand, Peter. They'll come down, they'll go back up. I reckon it's in profit territory.
And to me, oil stocks like Woodside and Santos are nearly becoming trading stocks because long-term ESG concerns will kill these companies, but in the short term, we need them, as this war has proven. You know, all these old fossil fuels and the coal miners have all done well, but there's going to be a time when it turns, Paul, isn't it? It
is, and I think that's the problem with those companies. So look, some core portfolio stocks, but occasionally you've got to take a bit of profit. I think this is sort of profit territory. I reckon you'll get a chance to buy it back at lower down.
Okay, let's go to Zip. Now, you weren't in Zip. I was in Zip.
Oh, these tech stocks, Pete.
No, it's bad for the hairline, isn't it? But you actually wrote, you thought it was time to buy Zip. What price was that?
Well, I wrote it at about $1.90, and that's where I bought, and it's now $1.40, Pete. And I thought $1.90 after it got to about $10 looked like pretty good value. I thought the Sezzle acquisition was pretty good.
Plus,
right? And particularly as it was an all-scrip acquisition, and they raising capital. So and that sort of strengthens the balance sheet, which they need to do. Now it's $1.40. Our payments come, you know, pay now, buy now, pay later companies. When you're out of favour, you're out of favour. It's got to be a buy now, but maybe that analyst at UBS who set a target price of $1, and you might recall, Pete, in the story is there was such divergence amongst analysts in terms of target prices. One was saying $1, another was saying $5. You know, huge difference, and maybe the UBS guy will finally be right.
Yeah, he's had a lot of mistakes on Afterpay.
He's had a lot of mistakes. He called Afterpay to sell at 27 and went to 140, right? But he stayed with his sell call and his target. But
well, anyway. one thing I will say, Paul, and I noted only last week that PayPal, which is one of the biggest and best payments companies in the world, it was a $300 stock and got down to about 100. So that's a massive fall. But I do not believe payments companies will be banned forever, because at the very worst, Zip would have to be a takeover target.
Yeah, and I think that you're going to see that, people. Look, at some stage, you've already seen a bit of reversal in the US stocks. Hasn't really flowed through in the Australian market. The market ultimately will take its lead from what's going on with PayPal, what's going on with Block, you know, Adyen, other companies, they're the companies that and Spotify, it'll take its lead from those companies, and that's really what you need to follow in Australia.
It's a case of no guts, no glory. If you're buying now, I reckon they're eventually going to go up because they've got lots of customers. And I got to say, I might even buy more Zip, but that's me talking through courage rather than good sense. Let's go to the final story. The Fed, we're expecting the interest rate rise this week. What's going to happen going forward?
Okay, so 0.25%, that's locked in. What people will be looking at will be, first of all, the dot plot. That's where all the members of the Federal Open Market Committee...
They're all like state governors of Reserve Banks.
Yeah, there's about Federal Reserve. 14, I think there are. Maybe it's 16, don't quote me. But they actually give their expectations about interest rates over the next 3 years.
So guess.
And so there's a dot. So they don't tell you who it is, but they actually, you can see what they're expecting interest rates to do, and so that gives you an idea what their thinking is. Hasn't proved to be a great guide long term, but the market takes a lot of notice of it. And the other thing the market will be looking at is you'll get some updated, same sort of thing from the same 14 people on the committee, their expectations around inflation and growth. So it's not about the interest rate decision. That's already locked in. Everyone knows it's going to be 0.25%. It'll be just their expectations. And so what the market's going to be taking from this is what does the Fed really think is going to happen to inflation, and how much might interest rates need to rise down the track. That's what the market will be looking at tomorrow.
And out there, Paul, you've got a lot of economists thinking 5, a fair number saying 7, and some even say 10 interest rate rises in a row, which would be unbelievable. what these people are suggesting, if the average is like 5 rises, they'll have a big impact on negativity or positivity when it comes to consumers and business.
And a lot priced in. The 2-year bond rate is now up to, in the US is up to 1.7%.
Yeah.
The 10-year 2.15. So we're going up. There's a lot of interest rate increases built into the market. So look, the risk here, I think, is to go the other way. The Fed's not as aggressive, and whatever it sees, this maybe the inflation is being a little more transitory. Maybe it's a bit cautious because of what's going on in Ukraine. Yeah. Maybe it now realises commodity prices have had their spike. China's sort of, maybe COVID's breaking out there in China. Who knows?
Growing better than expected, but the COVID problem's coming back. So I reckon they're going to hesitate, Paul. And I don't reckon we'll see any more than 5 interest rate rises this year from the Fed, and I hope that's the case. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. How worried should we be about this sell-off of the stock market? Has Westpac turned the corner? And given the sell-off, what is Paul Rickard's very, very best buy? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Paul, there's a lot of panicking going on out there at the moment. Is the panicking exaggerated and unnecessary?
Well, look, I think an interesting day yesterday in the Australian context. That was a good bounce. I think the bounce yesterday was fairly predictable, Pete. I said about 10:30. That's pretty well the bottom for the day.
And a big sell-off by 10:30.
And it was, by and large, that. Obviously the lead's coming out of the States. And last night a bit cool in the US. They're worried about inflation. Looks like the number should be down tonight. So, and a few predictions coming up saying that core inflation has peaked in the US. So,
which I've been saying for a while. I hope I'm right.
Yeah. So look, I mean, if it's another really bad number tonight, down goes the US. So we're in that sort of cycle. So I think we're going to do some work here around the 7th. Coming back domestically, the US is going to do. It hasn't given up on the fear about more Fed and more aggressive Fed and higher inflation. That's going to take a while to work through the system. We have to work through ours as well, Peter. So some choppy days ahead. I don't think we've bottomed yet in the correction, but we're going to do a little bit better in the next couple of days. I sense.
Yeah, I feel as though for the next 2 months or so, there's going to be volatility, and the volatility will be on a downward trend, and then we'll start going upward trend if the inflation numbers start looking good. If then people start saying, well, maybe the bond market's gone too far in predicting these higher interest rates. As they pull back, some of these tech companies might look like good value again. And we saw tech stocks were bought overnight. So that kind of thing, it's going to be like a ping pong game between inflation, is it as bad as we think, and will interest rates have to go as high? But what I found really interesting, an interesting number I got last night, if you take out all the tech companies' imbalances on the S&P 500 and you equal weight every company in there, the PE is only at 15, which is a low number. Currently it's too high, and that's part of the reason why there's been a sell-off. So I think that we are in the bottoming process, totally agree. And
the other factor we shouldn't discount locally, Peter, is we've got an election to get through. Now, we know after elections markets used to do better, but if Albo gets in, the market really hasn't been too bearish about Albo so far. It's been a very small target. I just sense we may just get a little more concerned, particularly about some of these policies coming out, with wage increases. Don't discount offshore just getting a little negative. Should Albo be elected in a week and a half time? So that's why I'd be a little. I don't think it's yet the right time to pile into the Aussie market. That's what I'm saying.
The point I would make, Paul, is that if you went in now, I don't think the downside would be so great that your losses would be there for a long time. If you bought, say, 2 months ago, yes, but if you're buying now, I think there's not much further to go down. That's my best bet. Westpac, has it turned the corner, Paul?
Well, look, it was a better result, Peter. I mean, better than the market expected, largely because of a bit more aggressive action on costs. Yeah. And look, it had some one-offs as well, so you've got to be a bit careful saying Westpac's turned the corner. A lot lower in investment expenses in the first half compared to the second half, so they're going to come back. And again, as we've seen before, it's very hard to sort of cut your way to glory, right? Now, Westpac at least has maintained its very ambitious cost-cutting target to get to an absolute cost base of $8 billion by 24, 25. The other banks have abandoned theirs, so they give Westpac some credit.
Yeah.
But,
and you've been bagging Peter King, so this is you being nice to Peter
I'm
King.
being a bit nice, but maybe that's the easy part, and we've got to see some growth. We need to see, the thing that National Australia Bank is doing is actually growing their book, right?
Yeah.
They're out there competing, whereas someone like ANZ, pretty much asleep at the wheel is the way I described ANZ. So, look, Westpac, better than expected. Some positives in the result, but it's too early to say that Westpac has turned the corner.
Would you be happy to buy? Would you be happy to buy Westpac going forward?
Look, I think we know the banks. There's rotation between the banks, right? Collectively, they don't have that dissimilar strategy, right?
Yeah.
So, over time, the cheapest ceases to be the cheapest, and the most expensive tends to sort of get dragged back to the pack a little bit. So, I think NAB's still the best of the three non-CBA banks. Yeah. ANZ is the least interesting to me. Westpac, I'm about 50-50 on it. I think it's, it was down there at $20 a couple of months ago.
And, it was even 17 not long ago.
Yeah, so look, maybe, I think I wouldn't get carried away with Westpac at the moment.
Okay, let's go to the next big one, Paul. Given the sell-off and given your view, what is the very, very best buy in the market right now?
I think right now, Macquarie, Peter, it was $205 last week. It's $180 this week. It seems like the market's just said, look, that's a fantastic profit report last Friday, but that's as good as it gets. Yeah. It's going to be more difficult going forward, and it probably is. And also, the things that we're seeing in the US are going to potentially impact Macquarie's business because 70% of its earnings now come from offshore, not in Australia. And a hell of a lot of the earnings come out of its global markets and commodities division. That's from trading, right? Yeah. If trading becomes more difficult because commodity prices aren't going through the roof, there's less client interest, or alternatively, bond rates go up, that means, some of the corporate activity potentially slows down. That impacts some of their markets-based businesses. And I guess that's what the market is saying. But, if you think the US market maybe is sort of showing signs of, forming a bottom, Macquarie's a great buy.
Yeah, I think if the S&P 500 can make a comeback sometime this year, later this year, I think there will be a summer rally in the US. Macquarie will be a beneficiary. Its highest price I remember is about $215, Paul. It's at $180 now. That would be a 20% gain if they could get back to their old high. And my view would be, even if you bought it and it went up and then went down, it probably wouldn't go much below 180, 150 anyway. So it'd be another chance to buy
they also
a good company.
What the market attributed as pretty conservative guidance. Now Macquarie does that, right? Because when you've got markets...
Under promise, over deliver.
When you've got markets-based businesses, it's very hard to forecast what it's going to be. You can't control the external environment, right? Yeah. We've seen that before with Macquarie. But you're right. Macquarie it's a bit like CSL. Yeah. It has that tag about under-promising, over-delivering, and it has done that year in, year out. So I don't think
since the 1980s.
I don't think you put too much notice of conservative guidance. So that's mine. Peter, what's yours?
So my best, because I was going to say Macquarie, but my second best would be Xero. I think Xero is a great small business, real business company. I think most small businesses that start up nowadays will roll straight into Xero. Nearly every analyst on our show, when we ask them what tech company would they be buying now, they say Xero. Tech will make a comeback, but it will be the top quality companies. And I think Xero, it looks like a fantastic screaming buy at these levels. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. What in the hell is going on with the stock market right now? What in the hell will happen to inflation today? And what in the hell will the Reserve Bank do with interest rates? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Okay, Paul, this is my what in the hell version of mad about money, but it is like a what in the hell situation. Stock market, what's going on?
Yeah, so we're going to happen a third down day in a row in Australia today. Another 2% by the looks of it.
Bad.
Although we're doing better than the US, that really should be pointed out, Peter. And I think that you were quoting earlier the stats, S&P 500 down about 8%, this month. Yeah. We're only down a bit over 1.5.
Yeah, maybe 1.7, but still, it's interesting, Paul. The Dow is only down 4. So the less tech heavy the index, the less the index is down.
Yeah, and it's been a total turnaround in the market. I mean, what the market wants is profitability, right? This is back to the old traditional metrics of PE ratios and tech stocks. Unless there's super high growth, really are going to get caned until they're profitable. Look, Microsoft reported quite well after the bell.
Yeah.
Amazon not so good, but I mean they're okay.
They're mega tech stocks.
They're mega tech stocks, but anything else, particularly in the Australian market, continues to get caned. We saw EML yesterday get absolutely smashed on a. Look, not a good downgrade, but it wasn't a huge downgrade. I think the challenge there was the costs were growing faster than revenue, right? And that's the big issue a lot of the tech stocks have.
Do you think Paul, there's question marks whether Bain is actually serious about buying EML? Because that was one of the stories why EML went up, wasn't it?
Look, I think there are a whole lot of things. You had a bit of insider selling the week before that you pointed out, which doesn't look good. It was only a small amount, but those things never help, particularly in front of a downgrade. Yes. So you've got to question the timing a little bit, right?
That's right. And the chairman saved himself a lot of money by selling before the sell-off, but he wasn't to know, I presume. Look, the bottom line to me, Paul, is people are wondering what's behind all this negativity. And I answer, well, the Ukraine war is not helping, but the China lockdown is getting worse rather than better. And I think it's escalated the fears that maybe a recession is out there to happen in 2023. And the bond market, which you're an expert on, the yields have come down. And ironically, that's why tech stocks actually do well for one day, and then they forget that. So, Paul, do you think it is like the recession fear is?
I think the recession fear is overdone. I mean, we've still got full employment in both Australia and the United States. So it's very hard to have a recession when we've got full employment, right?
Yeah.
We're not getting any of the lagging indicators like employment, being challenged. So, look, let's wait and see. I think this is sort of market nerves.
Short-term nerves.
And we're used to that, so we've just got to sort of hold your breath. There'll be a bit of a buying opportunity. I think today is probably not a bad one to look at, but you don't need to use all your firepower up. It's only less than a week ago, we were that close to an all-time high. Yeah. So the pullbacks are inevitable, and we just got to go with the flow here a little bit. Yeah,
and I think the really important point to make is that the expectation was if Ukraine and China's problems dissipate over a 3-month period, we expected a pretty solid global rebound, and that's why the Fed was looking at lots of interest rate rises. Well, now that's all being wound back, and the fear then is, this could be a recession. But it's guesswork, we don't know, and I think we have to keep our fingers crossed that the kind of negativity we're seeing now is really overdone, as it is overdone on the high side, overdone on the low side. Let's go to the inflation story today, Paul. What are you expecting?
Well, look, I think it's probably going to be towards the higher side of the forecast, about 4.5%. Let's just get and see how that comes out. I mean, I think the interesting thing is not the number. I mean, obviously, everyone's looked at the trim number, the actual core number, to see what that really means. Does that push the Reserve Bank further? Look, I reckon it's time for Phil Lowe to show a bit of guts here, right? I mean, I can't understand this idea, we might increase rates, but we're not going to do it for 2 or 3 months. You either increase them or you don't, right? So he's being pushed around by the market, right? You got to say he's being made to look an absolute goose, right? It was only in October last year, right? The Reserve Bank said we're not going to increase until 2024 at the earliest. Now we're talking about May. Less 7 months to that date, the last RBA statement in October, and he may do it, in mid 2022. So, look, does he have some spine? I don't know which way he should go. Given that he hasn't wanted to do it, I'd hang on.
Yeah, me too.
But wait till June, because that's what you sort of implied. But if he gets pushed around by a couple of economists saying it should be next week, well. Yeah, I don't understand the Reserve Bank.
And there's a bit of a pile, and not just a couple, there's a lot of economists now saying they're going to move in June. Now,
some are saying they're going to move to next week. That's the current view. So that's the call. Yeah. So let's see what the inflation number brings.
Because in many ways, if the recession story we talked about in our first story is right, even the Fed might be far more hesitant in raising by 0.5%. If the recession fears are getting bigger and bigger and bigger, sure they've got the inflation issues to deal with, but I just think that if I was Phil Lowe, I'd wait to see the wages data next week as well, and if it's not too bad, I would actually just wait till August, but still we'll have to wait and see. On that subject then, Paul, interest rates. Where do you think the Reserve Bank's going to go with interest rates?
Well, higher, but look, I think
how
they're
high?
good.
Three rises
I
a
don't
year
know.
or
I mean, look, I
five?
think they're probably going to be about 1% by the end of the year. I mean,
Go
my
from
fear
0.1
is
to 1.
they get bullied by the market, right? And the markets aren't always right, just as the central banks aren't right. And they've got to show a bit of fibre here, right? Either if they were that convinced October, as recently as November, that we saw a patient, and that word patient's just gone in the last month. Well, they can afford to be a bit patient, right?
Yeah.
But let's look. I think it needs to be orderly. They don't need to throw the economy into recession, and so that's what they've got to be careful about. I mean, I'm not sure a whole lot of interest rate rise is necessarily going to stamp out inflation, right? Inflation here has been caused by outbreaks it's the residue of the pandemic. It's a supply chain issue, right?
It's not really the demand kind of inflation that can be curtailed by rising interest rates. I think you're absolutely right. I did like the analysis by Tim Toohey, who was the former Goldman Sachs chief economist here in Australia. He's now with Yarra Capital. And he actually made the point that he thinks there'll be 3 interest rate rises. To me, that's a measured approach considering we have a strong economy. We haven't got supersonic inflation. America's over 8%. We're still under 4 until today.
Yeah, let's see what today brings, shall we?
Yeah. So the bottom line is, I think that there is, particularly with all this talk about recessions around, why would the Reserve Bank go mad on raising interest rates really quickly? So I think the jury's still out, but as far as I'm concerned, I think the Reserve Bank really can take its time before it becomes excessive on interest rate rises. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.
Shh.